Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, December 12th, 2017. I had an inquiry in the trading room from a member asking my thoughts on GDX, and as I get over the years more inquiries on gold and GDX and any other security or asset class, figured I'd do a video on this. For the last several months now, I've made it pretty clear that I was standing aside of that trade, the gold and gold mining stock trade, is the charts just weren't clear, and the trend has been a painful sideways to downwards grind. So I'm glad I've sidestepped it. But a week or two ago, I mentioned that we may be coming up on the next buying up here in gold. So I'm seeing some developments right now in the charts that may be actionable. So I'm going to go over those in the video. I'll start out here with a long-term look on gold. Actually, I need to flip over to another chart for you real quick. Hold on one second. Okay, there it is. We'll start out. This is a 20 plus year chart, goes back to the 90s. You can see here, um, late 90s. So it's a weekly chart on gold, GOLD. That's the gold continuous contracts, the continuous futures contracts. So it just shows you gold really for long term. And the case that I'm going to make here is just to reaffirm the case that I've been making for a while now, that I do believe we're in the early stages of a new bull market in gold, meaning we had a bear market. If we go back here, let me just click on some annotation tools down below and then I'll highlight it. This was a tail end of a bear market in gold, and that ended back in the mid 90s, about or mid 99, I should say, right before uh, the dot-com bubble burst right there in March of 2000. So there it is. Gold bottomed in mid 2099 or 1999. I'm sorry. Crazy long day. Anyways, this is the subsequent bull market, very, very powerful bull market, which most of us probably remember. If you're trading now, you chances are you were trading or at least investing or aware of gold's run back then and the miners. And then gold peaked back in 2011 and went on to have a pretty vicious bear market. It doesn't look like much here. I'm using log scaling on this chart, but you can see with the price compression over here, that's what log scaling will render. I highly recommend log scaling when you're looking at an asset class or anything that's or stock that's had such a large price differential, I should say, on the time period that you're viewing, such as gold here, which was down around 250 an ounce, all the way to almost 2,000 an ounce over this time period. So there it is. That was the end of the bull market. And then this is, I think, the case, and I'll make it here for those of you that haven't caught my analysis, that we're most likely in the early stages of a new bull market in gold. All right. So and within, a secular bull market, you'll have sharp corrections, maybe even cyclical bull and bear markets within a secular bull market. So let's just take a look at the facts here, and we'll move on and hone down in on the daily and 60-minute charts. I'll give you some levels to watch. All right, so this is we'll start from the top here. I had to shrink this chart down. I usually view these much larger on larger monitors. I have a little slice of my monitor capturing the screen recording here. So the text, since I shrunk it down in the browser, might be a little small, hard to make out. Since the 2011 top in gold, which I put new secular bear market, meaning right here, the weekly RSI has failed to exceed the 70 level, as is common during primary bull markets. What I mean by that is, okay, so let's clear these annotations out. And remember, this was the bull market right here, from this low all the way up to this high. We came back in, almost tested that low, but made a higher low there. So this was the bull market here. And as I noted above, I missed one right here. I'll highlight that now in yellow. You can see all these green shaded boxes. My point being that overbought readings. Overbought is a reading of 70 or higher on the RSI. Here's the RSI scale. Those are common during bull markets. And as you can see here, we didn't have a single reading, oversold reading, throughout that bull market. The RSI, the weekly RSI in gold, never ever hit that 30 level, never crossed below it. It did, however, leading up to the bear market, or I'm sorry, at the end of that bear market there, you can see these deeply oversold readings. So this is just my point being, this is uh, a sort of a tell, if you will, if you're in a bull or bear market. This, again, the top was put in here on that bull market, and this was our bear market, or at least the case that I've made. And you can see here, as is common, you had oversold readings during that bear market, and you didn't have a single overbought reading during the bear market right here. You can see we fell shy on the RSI right there. So that is, well, we all know in hindsight, it's nobody can argue that was a 50% or so drop in gold prices off the 50% Fibonacci retracement. There's a 50% fib there. So certainly a bear market in gold. Nobody can argue that. And then my point being is on that first rally, the case I made, and I was making it before it happened, that a break above this downtrend line would be the first bullish technical event or sign that we may very likely be in a new bull market. So we broke out, we back tested that trend line. We had a successful back test, so that's all good. And you can see at that point on that initial rally, we became overbought again. So what I'm trying to do is make the case here that gold is most likely in the early stages of a new bull market. And I added let's clear out some of these annotations so we can focus on what I'm looking at now. That was a very important trend line. It was broken out, successfully back tested, prices moved higher. We still need to take out those highs from 2016 right there. That will help further strengthen the case because you can't say with certainty when you look at this chart, you can't say with absolute certainty that we're in a new bull market. Sure, by the time if and when we go to take out those 2011 highs, in hindsight, you're going to be able to say that. But right now, I think the case can be made, and that's what we do in technical analysis. So an uptrend is simply defined as prices making a series of higher highs and higher lows. So far here, we had a higher high on that initial thrust up in uh, 2016. Then we had that correction, and that put in a higher low. And so now we'll need to take out that previous reaction high. And it's going to take a little while to do it if we do it from here. Of course, nothing's certain, but let's again look at the facts here. So I have this alternative downtrend line, or I should say secondary downtrend line. It really runs almost parallel to that first one, and that capped that advance. So you can see 1, 2, 3, 4 reactions, and we recently broke out. Now what I need to do, I'll zoom in here. Before I zoom in to look at the price action there, let me just point out um, one of the reasons and a big driver as to why I was looking for a lasting low in gold, and still think that that would be the lows back in late 2015. I think it was December 2015 that gold bottomed. The miners bottomed in early 2016, just a couple months later. But the one of the points that I was trying to make here is that we had very powerful bullish divergence at that low. You can see it marked there on the RSI, down below on the PPO, just as we had negative divergence. You can see there at the highs that ended that bull market, just as we had bullish divergence back here at the bottom of that bear market that ended in 1999. You can see the positive divergence. So again, we're spanning over 2 decades here, and I'm pointing out the only three major divergent, two divergent lows, one divergent high. Both of the, well, at least we know for a fact, we can say in hindsight that divergent low back in 1999 marked the end of a bear market in gold and the beginning of a new secular, big bull run. We can say in hindsight without, questioning it now that that's divergent high marked the end of that bull run. And I think in time we'll be able to say, wow, that was and I can still tell you it's a very powerful divergent low. Whether it turns out to, bring gold up and ultimately above these previous highs or not, you can't argue that. So that's that. And so therefore, I know I spent a lot of time here on the longer term charts, but I wanted to make that case. And the reason it's important is when we get into the daily charts here in a minute, which we will, it makes a difference whether you're in a bull market, primary bull market, or a bear market with some of these indicators that I'm looking at, and how you should interpret those and use them, incorporate those into your trading. Before I leave this chart, I just wanted to zoom back into the normal size here. You can make it out a little bit better. There's gold taking out that secondary downtrend line and currently back testing. So you have it at support right there. And let's zoom on and zoom in now, go down to the daily charts, and we'll look at GLD. Okay, this is GLD. This is a daily chart spanning, goes back to the beginning of 2015 here on the left. So you can see prices, and again, these are different divergences when you look at a different time frame like this. These are, your divergences, and they're just as useful whether you're looking at a weekly time frame, a daily. But when you get down to the daily time frames, especially the intraday charts like the 60 minutes, it helps you hone in on your entries. This is the realm of a swing trader. The longer term charts help you kind of get the bigger picture. Where's a trend? Where are things likely headed? And this will help you call the near term rips and dips a little more accurately, as will going down to the 60-minute time frame or any other intraday time frame. So what stands out to me? Well, you can just study this chart. I think I have a live link to this chart on the homepage. Um, you can see the trend line breaks. You want to, during an uptrend, you're long until a trend line break, and you can short. We had support here recently. That trend line was broken. But what stands out right now, I have a gold or GLD at support, maybe a hair below, but this is a pretty decent support level. There's quite a few gaps. There's two gaps in there. There's another gap there, another gap there, and these are all reactions. When you have prices stop there and then you gap down, reaction there, and go back in time, there's a reaction there. So it's not a super solid support level, but it is support. And more importantly, not only are prices at support, but you also have an oversold reading. And where I was going with the longer term charts, it's been my experience that during a bull run in most securities, most asset classes, gold, even any stock out there, during a bull market or a bull run, oversold readings are they're much more infrequent, and they're typically very fleeting, meaning during a bull run when you have oversold readings, that's it. It's usually one and done. You kiss that 30 level and boom, you're off to the races. So if we clear this out and take a look here, you can see that we had the last couple were right here. There's one. That's where gold was, and you can see, boom, look at that huge rally. We were oversold right there. Boom, that was a time to step in and buy and catch that rally. We were, and I will say this initial run was so powerful in gold off the lows, and that's also indicative of, the initial run in a bull market. Look at the stock market off the March of 2009 lows. You saw such a powerful run. We got very overbought. Um, you know, uh, this was a great trend, but we became extremely overbought. We had negative divergence. Everything was pointed out here. Therefore, the correction was pretty sharp. And I think that also aligned with the US dollar, my analysis on the dollar. So this correction, I think, was exacerbated by strength in the dollar. And even if so, I will point out that we did become oversold and stayed oversold for quite a while, but that's rare. Again, if this is a new bull market that we're in gold, and if it is, then you want to go long on these initial tags. At least if you can line up, I would never go long a security just because it's oversold, because I just said a minute ago, oversold can become more oversold during bear markets. Oversold often does become more oversold, meaning you first were oversold way up here. If you look at this, we're probably oversold somewhere here at this point, but we continued to fall and became more oversold. And that's a reason why oversold in itself isn't a buy signal. But if you can align some other things on the chart, such as support levels, divergences, bullish chart formations, breakouts, things like that, then it increases the odds on the trade. So there it is. That was another divergent low right there heading into the lows. I should have had that marked on this chart. You can see it there in the positive divergence. And the flip side to oversold readings, staying oversold or becoming more oversold during a bear trend like we were in here. Remember, this is when gold bottomed back in December of 2015. Is that during bear trends, overbought readings are usually very fleeting. Usually get that one and done tag of the 70 level, whereas in a bull market, and this again helps support my thesis that gold is most likely in a early stages of a new bull market. Overbought, which is any reading of 70 or higher on the RSI, 30 or below is oversold. Overbought tends to become more overbought like it did here, or stay overbought. So we were persistently overbought. We tagged that level there, we tagged it again. So we were overbought here for weeks, if not a couple months. And that's a common. There's another overbought reading I didn't have circled. So there's the point. This helps make the case. This type of action, persistent overbought readings, are something you typically see in a bull market, and during a bull market you see these very fleeting oversold readings. So that's my case, and this is it right here. There we are. We're oversold right now. All right, let's move on and zoom on down a little bit more. Flip over to another charting program. This is GLD on a weekly chart. It's that same pattern. I'm just looking again at a different charting program. There's that breakout back test and moving up. Now, looking at this, I'm going to play devil's advocate here, because if we do go lower, if the support doesn't hold, the next support, and I can tell you this right now, it's a much better support, is right here. This line here on GLD. Look at all these reactions. Just go to the left of the chart here. You have a lot of reactions on or around that level that have capped advances or pullbacks. And I think this is a very significant support level. That's just below the 115 level. I'll try to give you the exact number in a second. So if we do smash through here, all is not over for gold. It might have a little more downside, and then I would certainly think the odds for a reaction here are very good off this level. This is a weekly chart again. Interesting to note the trend indicator, the PPO right now, this line, I tried to circle it here, is above zero. That's bullish. Let me give you that level. That's about 114.50, we'll call it. And let's zoom down now to the daily chart. Daily chart, and again, there's just a mixed bag of technicals, and that's why I'm not all in bullish on gold right now. This, is not done a great job. The PPO often works, the PPO signal line, I should say, 9 EMA, often does a good job of defining trends. But in gold, the trend has been so whippy. Gold has traded, since the lows, certainly since that 2015 lows, it's well off those lows, and we're still above that major reaction low we had at late 2016 as well. We're still above there, but it's been a sideways trend. When you get a sideways trend, what happens? The indicators and oscillators move around, bounce around, they cross the zero line. You don't have any firm sell signal, but I will say that that signal line is below zero. It has been for a while. That's not a great sign. Let's look at 60-minute chart, see if I have anything there for you. I haven't marked up this 60-minute chart, but I just made the case on those GLD, the daily chart and the weekly charts, and I'm going to go to GDX now, and we'll wrap it up. We'll look at gold futures and then wrap it up there. What I see here, well, trend indicators are still bearish. That's not really good. Right there, you can see the 9 EMA is below zero and has been since this level. And as such, you can see, GDX has been moving lower. However, all right, let's forget about what's happened and look at what's coming up here. We have a lot of reactions here. This line, let me give you that level first. It's 2112 is where I have that line placed. That's not a hard level, but you can see here there's a lot of reactions on GDX. GDX has held support on or around this level on every pullback since this divergent low here. You can see that support, support, support. These were also divergent lows. Why we don't have really any divergence right now in place, and that's also tempering my bullishness a little bit there. We don't have any bullish divergence. I would much prefer to see that. We do have that oversold reading, and again, if we just look at GDX here, let's just do the math and see what happened the last couple of times. We're oversold now. We were oversold here and oversold here and oversold here. So I went back to the previous three oversold readings. 1, 2, 3. Okay, we never made it oversold there. So the odds are in your favor for a bounce soon. At the very least, an oversold bounce off support. Again, you can also see GDX coming on up on that support line. And finally, if you want to see where gold is going, well, all you have to do is look at gold futures. Let's take a look here. Kind of kidding aside here, but these are gold futures. These are the continuous contracts. I believe I pulled up here. It's 60-minute chart, and I really like to use a 60-minute chart to kind of hone my entries and exits. And what do you see? One of my favorite patterns, bullish falling wedge right here. You can see the trend line, quite a few reactions. You have the positive divergence down below on both the MACD here and the RSI that confirm the bullish nature of that wedge as a reversal pattern. Prices are just now breaking out. So if you trade gold contracts, gold futures. Looks like 1251, roughly 1258, and 1265. Those are my levels. Those are my near-term targets. And try to give you an idea on GDX. Let's look at the 60-minute chart. I have a bullish falling wedge here. I also have potential divergence. If we turn up soon, if we break above this wedge, these divergences will be confirmed. Actually, I think this would be better on a 30-minute chart. Yeah, there it is. All right, so we're looking at a 30-minute chart on GDX for you swing traders. If you want to trade nugget, you're just juicing up your returns 3 times. 6 to 1, half dozen to the other. If you have a margin account, you can buy 3 times the amount of GDX. Or if you don't, you can buy Nugget, trade that. So there it is. You might want to replicate this bullish falling wedge on your chart. There's minor resistance there around 2146 or so. Break above that level. I really don't see a whole lot. I could add some very short-term targets in here, maybe a hiccup here around the 2180 level. But I think this one plays out something like this. If we break out here soon, move up to the 22, 23 area. And to try to quantify it for you in GDX, that would be a pop of about 4%, which would give you, of course, about a 12% move in Nugget if that plays out that way. So those are some near-term targets. If you are a longer-term trader, not an active trader, and you're bullish on gold and you want to look for an entry, this could be a potential runner. You could enter a trade here in GDX or the miners or gold, whatever you want to do. Set a stop, just below entry, trail those stops up, and this could be, in hindsight, we could be looking at the end of this pullback with the next leg in GDX and gold to come. I don't see enough in the charts to say that with confidence yet, but there's nothing wrong with, buying in here. It's objective. Set your stops somewhat below where we're at today. Keep in mind the aggressive nature of the mining stocks. They can move up and down. I've seen GDX many a time move up or down more than 5% in a day. So if you're trying to trade GDX with a 1% stop, 2% stop, just the intraday gyrations are going to run your stops. You got to give it a little room. But the way I handle that is take a smaller position size. Take half of what you'd normally trade in say QQQ or something like that, because your gain potential is going to be outsized as well. So, if you're shooting for 10, 20, 30% profit potential, sure, you can take a half position size. You make 30% on GDX. That's still like making 15% on any other given average trade. All right, so there it is. I'll leave it alone. Wrap this video up here. And as always, if you want updates, if you're in this trade, and I haven't put anything up in a while, just bump me in the trading room, and I'll be glad to share my thoughts. This has been Randy Finney with the Right Side of the Chart. Hope you enjoy.